In this presentation, we will take a look at the income tax formula. This is the formula that the Form 1040 represents. In other words, if we look through the 1040 and see what actually happens as we enter information into the 1040, then we'll see that this is the formula behind it. Really useful to know the income tax formula because to really understand the tax code, we need to think about it in a few different ways. One, it's really helpful to actually go through the tax forms and enter it by hand so you know how they all tie together. And by doing that, you get a sense of the formula, but it's a lot easier to see the formula if you pull it out, distill it, and put it in terms of simple terms of what the formula is. That's the other way we want to see it. We want to see it in terms of just a formula. And if we can kind of verify our calculations in the 1040 with just a formula, that's one way we can verify our taxes and be more assured that our taxes are entered correctly. The third way we want to consider the taxes is, of course, with the software, where we oftentimes rely a lot more on the data input. We rely on the data input screens and the software to help us out to then do some of the calculations for us and actually fill in this information to the proper areas on the form. We do not, however, want to be so dependent on software that we don't have any idea of the calculations, because then we won't be able to see if we're doing things right or wrong, and we won't be able to make projections and do things like that about the future in a relevant way. So the formula then will be starting with, for more accounting information and accounting courses, visit our website at accountinginstruction.info. The income. And then we're going to take deductions from income. And remember what we're talking about here, even though it's an individual income statement, we're talking about, in essence, an income statement. We're not talking about the balance sheet. We're not getting taxed on our house or on our car or things like that. We're getting taxed on the income we've earned. Now, the water gets muddied in terms of the income that we earn being taxed with individual taxes because, for example, many of the deductions we have, you might say, we're getting a deduction for the house and possibly for interest on the house or taxes on the house and things like that. So the income statement is a funny income statement. It's a really messy income statement. It's not like a normal financial statement type of income statement we would put together if it weren't for the tax code. And there's many different reasons why the tax code is built that way. But in essence, it is an income statement. So we're getting taxed on income. It's federal income tax. So that's where we start then. The income is going to be where we start. And we'll have to go through each of these lines at a later time and say, okay, well, what's included in each of these lines? What's included in income? And then we're going to have deductions to income, or above the line deductions often called. What is included in those? We'll talk about that later. But in a general format, general formula, this is it. And that'll give us the adjusted gross income, or AGI, adjusted gross income. And that's a subtotal. Then we'll subtract out the greater of the standard deduction or the itemized deduction. This is where the complexity usually comes into play. What's the difference between a standard deduction and an itemized deduction? Which deductions fall into above the line and below the line? This is often called below the line, or the itemized deductions. What types of deductions are in there. We'll get more into that. This is really the category where most people, when you hear different types of deductions like charity or the property tax or mortgage interest, really falls into the itemized deductions. But there's this rule that on the standard deductions that you only get them if the itemized deductions are larger, or it only makes sense to take the itemized deductions if the itemized deductions are larger than the standard deduction. That'll give us the taxable income. So we're finally down to the point where we can say, okay, here's the taxable income that we can apply the tax rates to. And when we say rates, we don't mean rate singular, rates plural, because we do have that progressive tax system. So this is where we oftentimes are reliant on the software, because we don't typically go through the tables to figure out manually what the tax is. The software's usually going to help us to kind of figure out what that tax will be, but we could go through the tables and figure it out. If we were to do so, we would remember that it's going to have multiple tax rates for one individual, not just one flat tax. And then that'll give us the tax before credits and payments. So this, in essence, is our tax. This is still a little bit confusing, however, because credits are really kind of things that we get as part of our tax calculation, but they are as powerful as payments. In other words, credits are much more impactful on how much we will owe or how much we will be refunded than deductions are. They're much bigger. And they're equivalent to payments, as if we actually paid the IRS. We get dollar for dollar credits back. So that means that we have to group those together after the tax calculation that we're going to have. So now we have the taxes before credits and payments. Then we'll subtract out the credits and the payments. And remember, most of the payments we make, if we're W-2 employees, have been made already. We've been making payments, but they've been taken out of our paycheck in the form of withholdings. And so those have all been paid. And that'll give us our end result, which will be the tax owed or refunded to us. For more accounting information and accounting courses, visit our website at accountinginstruction.info.